Hi everyone, thanks for downloading the Lighthouse report. I created an article on the reverse repo market, and as you can see, the reverse repo market has gone parabolic. We're at $2.2 trillion, and at one point it spiked to $2.3 trillion. And what's going on here? This is cash by money markets and banks, and they're giving it to the Fed for an interest rate, and the Fed's offering 3.35% interest. Now, when you deposit money in a bank or money market, that's liabilities of the money market. That's a liability of the bank, and now they have cash, and it's a liability for them. So they are seeking places to balance their liabilities with assets, and the banking laws require them to have that balance, right? So they have too much cash, they lend it to the Fed overnight, and the Fed overnight gives them UST bills, and with hefty 3.35%. Normally, you can go into the free market, and bonds are at, the 3-month bond is at 2.686%. So why is the Fed luring all these banks and money markets into the reverse repo market? Well, this is dry powder for the Fed without actually having to print any money. So we're in this economic downturn. The Fed is their hands are tied behind their back. They have constraints. They're not allowed to just print money right now. They're trying to lower inflation. They're trying to move to quantitative tightening. They're trying to, sell some of the bonds that they have into the market, as well as raise interest rates. So this $2.3 trillion is a big number, and that can move markets. So if that $2.3 trillion were to buy 3-month bonds, this yield would lower. Bonds and yields are inversely correlated. So if this 3-month were to spike way up here or something, this bond yield could even go negative. And the banks are absolutely required to have these treasuries, as well as stable coins are now buying these shorter term bonds, as well as money markets and a USDC, USDT. They're both buying these treasuries, these short-term treasuries, to back their stable coins. So at the same time, the U.S. government, they're not issuing these shorter-term bonds. They've made money with tax receipts, so they didn't really need money until as of late. And now what they're doing is they're issuing longer-term bonds. So anywhere between 2 to 20-year bonds, they're issuing because it's cheaper for the U.S. government to do that. So there's a shortage of these short-term treasuries, and these are the instruments that banks and money markets need. So they need to have it in order to actually balance their balance sheet. Now, you can see back here, this was in March 2020 during the COVID recession, I guess we'd call it, but the reverse repo market spiked, and then it dropped right back down to zero. Right. So what happened here? So the SLR is the statutory liquidity ratio, and what happened during this time is the Fed waived a lot of the constraints that banks and money markets had on their assets to liabilities, and they gave a timeline, March 2022, and you can see right around here, this is when March 2021 rather. You can see right here is when this all started. So they waived the requirements, it went to zero, and now this is starting again. So what's going to happen is the Fed could either waive their requirement again, or they can just lower this interest rate to zero. Then this gets dropped down to zero. This reverse repo, all this cash gets flooded into the system, and then these bonds get bought up. So if we see interest rates on the shorter term bonds start to spike out of control, the Fed can actually just have this $2.3 trillion buy up these bonds without actually printing any money. It's not their money, it's the banks and money market funds money. So they're kind of doing this balancing act where they're manipulating the market, and it's their dry powder to manipulate without any of the negative consequences of printing up the money. So that's what's happening in the reverse repo market. I hope you guys enjoyed this video. Tell me what you think.